Every time you buy or sell an options contract on the S&P 500, somebody has to take the other side. 90% of the time, that somebody is a market maker. Market makers don't want to bet on direction. They make money on the bid-ask spread, collecting the difference thousands of times per day. When they sell you a call option, they now have directional exposure. If the market goes up, they lose money. So what do? They hedge. They buy futures to offset the risk, and every single options transaction triggers a hedging response. Let's walk through a concrete example. A trader buys 100 call options at the 5,800 strike. The market maker sells those calls. Each call has a delta of 0.50, giving total exposure of 50 delta. To neutralize this, the market maker buys 50 ES futures contracts. Now they're delta neutral. No directional risk. The option exposure and futures position cancel each other out perfectly. But here's where it gets interesting. Delta isn't fixed. As price moves, delta changes. This is gamma. If the S&P moves up 10 points, delta might increase from 0.50 to 0.55. Now, the market maker needs 5 more futures contracts to stay hedged. Price goes up, they buy more. Price goes down, they sell. This is continuous, all day, every day. And it's happening across dozens of dealers managing hundreds of billions. When gamma is concentrated at a specific strike, something remarkable happens. In positive gamma, every time price moves above the level, market makers sell. Every time it moves below, they buy. They're constantly pushing price back. That level becomes a magnet. This is why on certain days, ES trades in a 10-point range around a round number. It's not random. It's mechanically stuck by hedging flows. And these levels can be identified before the market opens. In negative gamma territory, the mechanics reverse completely. Instead of dampening moves, hedging amplifies them. This creates a feedback loop. When price drops, delta on puts increases. Market makers sell more futures. Their selling pushes price lower, which increases delta further, which forces more selling. It cascades. This is the mechanical reason behind those days where ES drops 50, 60, 80 points in a straight line with no bounce. This is why your trading strategy must change based on which gamma environment you're in. Positive gamma, fade the moves. Buy dips, sell rips. Expect tight ranges. Negative gamma, ride the trends. Don't fight the direction. Expect follow-through. Let me show you exactly what this looked like this week in ES futures. On Wednesday, real-time hedging flow reached plus 15 billion in net delta. At 1 p.m., price breached the 7,000 strike, where 15,000 0 DTE call contracts were sitting. Short call holders were forced to cover, triggering a delta cascade. ES squeezed from 7,000 to 7,026 in 2 hours. This was not sentiment-driven. It was a mechanical positioning squeeze. The hedging feedback loop pushed price through resistance. And now, heading into Friday's monthly expiration, that positive gamma is about to get stripped, which means larger two-way moves ahead. The market isn't random. Market maker hedging creates price magnets in positive gamma, acceleration zones in negative gamma, and predictable shifts at the flip level. Understanding the hedging mechanism gives you an edge that most retail traders don't have. In Episode 3, I'll show you how to actually read gamma levels, where to find them, how to plot them on your chart, and how to use them for entries and exits. If you want to put this into practice, you don't want to miss it. Subscribe and hit the bell, and I'll see you in Episode 3.